Yes, I will in just a second.
Take your time.
Well, ladies and gentlemen, please take seats. I hope you had a relaxing and interesting coffee break. I'd like to continue the conference. I'm glad to see that you are in discussions, obviously, also from your participation. Very nice, thank you very much. We had a great dialogue, which I enjoyed very much. In the video at the beginning of the conference, we heard Nobel Prize winner Robert Hill saying that the negative interest rates that we are seeing are not particularly effective, and we need to do something different. I think most of us will agree. The big question is, of course, what should we do different? And therefore, I'm very curious about our next speaker and the role of central banks in monetary policy. It's Bradford DeLong. He is professor of economics at the University of California in Berkeley, and among many other things, he served as Deputy Assistant Secretary of Lawrence Summers, the Minister of Finance in the Clinton administration. Bradford DeLong, thank you very much.
So, thank you very much for inviting me to this wonderful city here in Europe, albeit not at the time of year when it looks to its absolute best. It looks a lot like Boston, Massachusetts, where I went to school in late October, although Boston is even rainier. And when winter comes, the likelihood is the snow will immediately melt to slush and be followed by rain. And it's Boston's standard way of being has about 3 inches of mixed slush, ice, and water everywhere for about 3 months of the year because it's on the coast and next to the Gulf Stream. And if only it were 2 months later or 3 months later, Zurich would be very, very pretty indeed, rather than gray and overcast. I'm afraid I have to disappoint you with respect to what new economic thinking will be brought to bear on our current problems, because central banks are not good at new economic thinking. They adopt new thinking only under great duress, under pressure of immediate and exigent emergency, and it does not look likely that we will see these, and if we do see these, we will not like what they bring with them. So let me start with background, with a brief tour of things, all of which you know, and then go on to the problems facing central banks and to, as best as I can see it, the likely future for what central banks will do as they try to manage the world global economy over the next 1 to 5 years. On the real side, on the real production side, we have what is called secular stagnation. A 10% fall in global North production as a result of the financial crisis that started in 2007 and continued 2009. No subsequent catch-up, no subsequent repair of the damage done to production by that fall, and a subsequent slowing of trend growth in measured GDP as well. Now, as someone coming from California, and as Mr. Donovan said before, these numbers are in some strong sense fake news. These are numbers of real goods and services produced and sold at the market, valued at prices that pretty much track how much it costs us this year to make what we made last year, and they do not take adequate account of the invention of new commodities and of new types of commodities and their contribution to human well-being. And they also do not take proper account of the fact that more and more of human activity that would have been called economic is in some sense moving away from the idea of purchasing and consuming and using material things. That is the way that the Google chief economist and my former teacher Hal Varian puts it. Human beings combine physical goods on the one hand, services on the other, information on the third, and communication on the fourth, in order to shape the universe to their will and to accomplish their purposes. And while it is certainly true that the financial crisis and its aftermath have slowed our ability to produce and deploy material goods and services, how fast that's growing, our ability to communicate and our ability to inform or misinform ourselves has continued to grow at a pace even more rapid than before. That if we had true numbers, they would have been showing an acceleration of the pace of human economic progress in the 1990s and 2000s, followed by a downward shock in 2007. Would they have shown anything like a decline in the rate of growth? Probably not. But for most of your perspectives, as people in finance, as intermediaries, with clients, with people who depend on you for advice and for management, the fact that there is an information age economy off there in the background that is by and large not fully tracked by these numbers is pretty much irrelevant, because that information age economy does not enter into production, the circuit of production, purchase, and sale fully. Instead, information goods are currently and increasingly produced and financed by the fumes coming off of the ability to sell the eyeballs of people paying attention to information to advertisers. And that does not enter into measures of real GDP. From your perspective, from the perspective of real financial flows, there is secular stagnation. There has been a sharp drop of the level of production in the global north, followed by no recovery to previous trend, and in fact a slowing of previous trend. And that shows itself in nominal long government bond rates across the global north. It's starting in 1995. Back when inflation was in the range of 3 to 4% rather than the 1/2 to 2% it is now. Starting in the mid-1990s, any fear that there would be a return to the inflationary decade of the 1970s was long gone. And yet long-term government bond rates, both nominal and real, were far higher than they are now. Since the mid-1990s, there has been a continual but sometimes interrupted process, both of convergence of bond rates and also of lowering of bond rates, which has produced a world awash in savings, which has produced a world in which virtually every financial advisor and trader who was ever short bonds for any extended period of time has likely lost their job, or at least had a lot of explaining to do. Has created a world in which lots of people expect there to be capital gains on the long bonds that they hold, because that's the world that they grew up in. Yet we now, looking at long bond yields, cannot imagine that this will continue for far. So we have a world that appears awash in savings, at least from the financial market price tests, or perhaps a world desperately short of properly safe assets, in which there are returns to risk-bearing and returns to entrepreneurship and returns to acquiring market power of one sort or another, but not returns to simply owning and applying financial capital, which is a very different world growing forward than the world of the past generation, during which holding financial capital and investing it long-term has produced not just the interest yield on bonds, but healthy capital gains as well. With little return to financial capital, there is also remarkably little return to bearing duration risk, which poses potential systemic problems, because there are a lot of financial institutions and a lot of money whose business model depended on accepting duration risk and trying to cut and minimize costs. And that's not been a terribly effective business model for almost a decade now. But organizations that are used to bearing duration risk, if they seek to gain returns by bearing other kinds of risks, they may well not have the proper management, not have the proper culture, not have the proper knowledge base to do so. And there is a return to bearing various forms of corporate default risk, but in the US at least, it's only 150 basis points per year, and that includes exposure to major financial shocks, which you can ride out only if your organization is well capitalized, and if the sources of your money are patient, and if you yourself and your entire bureaucracy can be patient and be willing to let positions ride for a year to see what happens all the way up the chain. Those are hard positions for organizations to establish and hold. And then there's going further down the risk spectrum to equities. And we still have a 4% per year real earnings yield on equities in the global north hanging up there, which is 4% real each year, which is a very attractive return in the current environment in which little else offers a attractive return. But is that 4% real really there? It hinges on there being no sharp rise back to normal in the labor share of value added, and it hinges on there being no reversal of current valuation ratios for equities. And when you look at valuations for equities, even if you're not Robert Shiller, who insists that long-time earnings yields of above 6% or so are unsustainable and are inevitably followed by a return back to 6%. Even if you are not Robert Shiller, you look at equity capitalizations, and you have to see that the danger's not just of a large V, but of an L, of a permanent decline in valuation ratios mimicking the rise that we saw in the 1990s is definitely out there. So, live dangerously in equities. Accept the fact that your returns will be very low if you invest in safe assets. Try to assure your investors and others that, well, they got the returns to the safe debt you hold back in the past generation as interest rates on government debt collapsed and as the value of your long government bond positions went up. And it's certainly true that they got their returns last decade and the decade before, but they don't want to be reminded of that. It is perhaps the most difficult situation to try to manage money in that we have ever seen, short of something like the Great Depression and the coming of World War II. The last piece of background is that back 20 years ago, when I worked for the Clinton administration, people from the United States would come to Europe and would lecture them about Eurosclerosis, about the absence of a European entrepreneurial and technological culture, about labor market rigidities, about how much better the U.S. more market-oriented economy was performing along every direction. Well, that is no longer the case. Not only are people in America not moving in search of opportunity, it's also the case that over the past generation, the U.S.'s market-oriented flexible labor market has produced a labor market in which fewer Americans want to even work to find jobs than people in Europe do, in which the rate of investment in human capital is lower, and in which our economy looks profoundly unhealthy in a manner that does not reach, but is in some ways reminiscent of what happened to the economies of the former Soviet Union in the 1990s. That the economies east of the Iron Curtain were the only economies outside the AIDS-ridden economies of Africa that saw substantial declines in life expectancy, kind of ever, since the great influenza of 1919 and 1920 of great peacetime declines in life expectancy. In 40% of the counties in America, women have shorter life expectancy now than they had 20 years ago. So that's the background. A background of one in which perhaps economic growth has not slowed down, but the ability to make money off of that economic growth by producing and selling goods and services has definitely slowed down, and that makes a world awash in savings in which it is difficult to deploy money and expect returns without taking on major risks, without being lucky enough to find impressive entrepreneurs to back, and kind of risk entrepreneurs, and without kind of being willing to figure out some way to attempt to substantially acquire market power in one form or another, all of which are very difficult things to do, especially if one is in the financial sector and thus trying to reach through to what happens to the managements of the corporations, of the operating corporations one invests in. So with that background, what are central banks likely to do over the next 1 to 5 years? Well, first of all, the European Central Bank and the Bank of England are likely to follow the Federal Reserve. Over the past 15 years or so, they have all been relying on the Federal Reserve to expand the policy space in which they operate. And they are likely to continue to do so over the next 1 to 5 years. To stay the course, to attempt to take advantage of Federal Reserve rate increases to perhaps reduce the values of their currencies a little bit to provide a boost to exports, but not to innovate in the policy space greatly unless they are given permission and example by the Federal Reserve to do so. And the Federal Reserve is unlikely to engage in policy innovation over the next 1 to 5 years. Right now, the consensus on the Federal Reserve is, with the exception of Governor Lael Brainerd, and perhaps Bank President Charlie Evans, and perhaps Bank President John Williams has recently been moving into a position more like that of opposition to the current consensus from the left, but even he is not fully there yet. The Federal Reserve thinks that the U.S. economy is near full employment, that U.S. measured potential output growth is 2% per year, and that it is the business of the Federal Reserve for financial stability reasons to normalize interest rates as rapidly as possible, both to make it somewhat expensive to borrow and to provide it with room to take action to fight additional negative demand shocks should they happen in the near future. That means that any positive shock to growth or inflation in the United States will see the Federal Reserve raise interest rates farther and faster than it is currently planning. Hence, do not expect real growth in the U.S. to accelerate above 2% per year. If it does, the Federal Reserve will take that as permission to raise interest rates faster in order to push it back down to 2% per year. Do expect federal funds rates to rise at about 0.75% per year, as long as the economy can stand it without recession. Do not expect bad news about inflation. Well, good news about inflation. News that inflation is lower than expected to affect Federal Reserve interest rates rise as much. The Federal Reserve will take any shocks, downward shocks to inflation, as evidence of temporary factors not of a permanent change. And we will not see a stop to normalization. We might see at most a small slowing of it. By contrast, a negative shock to demand in the United States, if the Federal Reserve becomes convinced that a recession is coming, it will quickly return the federal funds rate to zero, and thereafter it will tend to dither. Without another major financial crisis on the order of what we saw of 2007 to 2009, it will dither with many tools, but with none of them that have proven powerful at affecting the level of demand in the U.S. economy. That's what the Federal Reserve is likely to do. And other central banks in Europe are maneuvering in a context in which the Federal Reserve is the policy leader. The Bank of Japan is now approaching a situation in which Japanese employment and growth is healthy enough that it can no longer be flashing emergency red action needed, and is thinking it needs to start turning its hand to dealing with the overhang of Japanese debt. And the Chinese government's monetary and other policies will be overwhelmingly determined by things that happen in internal Chinese politics that I am not terribly competent to evaluate. They will simply attempt to stay the course and not introduce additional uncertainty and additional confusion into a political situation that, with the rise and maintenance of power by Xi Jinping, looks at least like somewhat of a deviation from the oligarchic succession consensus pattern established in the aftermath of the rule of Deng Xiaoping. Now, I think the Federal Reserve is likely making a mistake here. I tend to think that Governor Lael Brainerd's arguments are the more convincing. That I think the Federal Reserve could be more aggressive at promoting growth. That I think that prime-age employment to population numbers in the U.S. still show considerable labor market slack. But given that the unemployment rate shows near full employment, that's a contest. People can differ about that. I tend to think that wage growth shows no labor-side pricing power for workers, yet the Federal Reserve trusts the unemployment rate much more than it trusts other indicators. And that has it convinced that it is time for us to normalize interest rates, hence the slow tightening cycle that it is currently embarked on, and will continue to embark on even as long as inflation remains subdued. That it was back in the 1990s, not 1950s, that's a bad typo, that Alan Greenspan declared that 2% per year measured inflation was effective price stability. The Bernanke-Yellen Federal Reserve decided that it pushed the envelope of that by declaring that the price index that applied to was the personal consumption expenditures deflator rather than the consumer price index. That gave them an extra 0.5 percentage point to play with, because 2% inflation on the PCE deflator is close to 2.5% inflation on the consumer price index. Since January 2009, they have persistently undershot this 2% per year PCE deflator, kind of chain deflator kind of target, an undershoot accumulating to 4 percentage points in the price level by now, with recent price news not suggesting any inflationary spiral developing soon. And yet, throughout this nearly past decade, at every opportunity, the Federal Open Market Committee has reached for excuses not to believe what the inflation numbers are telling them, to believe imminent return of inflation to its 2% PCE target, and ignoring evidence that the tightening cycle announced in 2013 for the end of 2014 and then postponed for 2 years to 2016, that this tightening cycle was premature. And the market agrees with me. The market also does not see anything like a return of inflation in the United States to anything like its pre-2007 kind of trend of 2.5% per year on the consumer price index. The inflation break-even gives us a window, not a great window, but somewhat of a window, into what market expectations are. And so we see that the marginal investors and traders are kind of out here with Lael Brainerd and me in terms of our view about what the likely consequences of Federal Reserve policies are going to be. Modulus all of this, that various kinds of semi-disaster and disaster scenarios, both down the downside as far as inflation and demand are concerned and on the upside, tend not to be priced in to whatever financial markets are doing. That, as John Maynard Keynes wrote back in 1936, although I paraphrase, that there is virtually no percentage to a banker, to price or investor, to who with clients, to accurately price in tail events. Because if you succeed, the very fact of your success is regarded as evidence that your judgment was not so much wrong, but that your judgment was deviant. And the last thing one wants in a money manager is someone whose judgment is very deviant. And if you are wrong, if whatever particular tail risk you are hedging against does not come true, then you are underperforming your peers. And the fact that you had, in some sense, a better assessment of tail risk than they did, if we could rerun the economy 10,000 times, does not enter into anyone's calculus at all. So, do not expect the Federal Reserve to deliver much, if anything, in the way of expanded demand in the U.S., and thus either substantially rising asset prices for equities, or any substantial increase in the U.S. demand for imports from elsewhere in the world. Do expect U.S. interest rates at the short end to rise for about 0.75% per year, until the U.S. yield curve starts to invert at the 10-year Treasury level, at which point the Federal Reserve will do what it always does with a tightening cycle. It will stop, and it will wait, and it will try to keep the economy in that sweet spot for as long as it can, until something else happens, until an upward burst of inflation makes it think that it needs to seriously invert the yield curve to cool off demand, or until some financial distress and disarray makes it think that it needs to lower interest rates in order to try to stimulate demand. Is this particular scenario, is this particular pattern generating outsized financial risks? Well, last time the risks came from large money center banks that had exaggerated ideas of how much they controlled their derivatives books. And last time the outsized risks came from banks whose risk departments were a little bit too eager to engage in a little regulatory arbitrage and say that because these rating agencies have rated these particular derivative securities AAA, we can hold them as AAA assets. Indeed, at one point, at one conference, perhaps 3 years after the 2008-2009 financial crisis, former Deutsche Bundesbank head Axel Weber told a story on himself of how back in the mid-2000s he had been invited by mistake to a wrong conference at Davos, the organizers of the conference having confused the Deutsche Bank with the Deutsche Bundesbank, and so put a central banker on a panel with 5 heads of major banks, all of whom were talking about how great their management of their derivatives books were and how well balanced they were to continue to squeeze every earnings dollar out of their capital, even though they were highly leveraged. And Axel, of course, had been their regulator. And so he was able to stand up and say, yes, you all are perfectly telling the truth when you say that your issue departments fully understand the risks of the securities you are creating, and that your originate to distribute business model is indeed sound and secure, and your issue departments are getting rid of all of these risks associated with mortgage-backed securities and other potentially risky things within 3 months of their creation. But the 13 of you are also the 13 largest purchasers of such securities issued by other banks, in part because they have been rated AAA. So what you are really doing is you are trading risks that somebody in your organization understands for risks where the only people who understand them are your counterparties and your competitors who have managed to sell them to you. And he said that if he had been smarter, he would have thought of this not as an amusing anecdote of the foibles of bankers, which he thought of at the time, but as a serious source of systemic risk, but he did not. Now, in the aftermath of that, every single regulator has learned, right? And every single regulator is not going to be caught making the same mistake again. The problem is that, as Hyman Minsky said, the true financial risks are ones that you cannot see almost by definition, because the risks that you can see are the risks that you can ask your traders about, and are the issues that your risk managers are embarrassed if they have not thought about when they are asked about them at supervisory meetings and also at other meetings as well. Back in 2005 it was, I was one August in a ballroom like this without windows, but instead of having a high ceiling, it had a low ceiling. And I began to feel claustrophobic, and so I snuck out of the conference, out into the forests surrounding us back then in Jackson Hole, Wyoming, looking up at the Grand Teton Mountains of America. And there I found Larry Summers and former assistant to the president for economic policy under Clinton and future Obama, Gene Sperling. And we then found that Tim Geithner had also gotten claustrophobic from his position as head of the Federal Reserve Bank of New York. And there we were out there in the forests playing hooky from the conference. And we asked him, of course, what you naturally ask him, which is, what will you do if all of a sudden China stops buying dollar assets and it turns out that major U.S. money center banks have been boosting their earnings by selling unhedged puts on the dollar, and so transformed America's dollar-denominated foreign debt into a renminbi and euro-denominated foreign debt, and put the U.S. in the position of Korea in early 1998. And of course, Geithner had excellent answers, because that was a risk that the Federal Reserve Bank of New York was seriously concerned about. And he is completely plausible about how there was virtually no source of systemic risk being generated by the global imbalance between the United States and Asia back then. And of course, I was not smart enough to ask him any questions about mortgage-backed securities, which were, of course, too small a asset class to possibly cause any trouble whatsoever. Similarly, if there were major sources of systemic risk out there right now, almost by definition, this community does not know about them, because if we did know about them, the appropriate people would be guarding against them. Is there anything that plays the same role now that mortgage-backed securities in the U.S. on houses built in the desert between Los Angeles and Albuquerque played in 2008? Not only can we not think of any, but regulators have learned from 2007, 2008 enough to try very hard to think about outside the box, and they are not coming up with anything. That does not mean that there isn't anything, but I think we can be somewhat more confident that financial risks are somewhat less than we would expect given the current level and configuration of asset prices that we see out there. Implications? Well, as I said, the Federal Reserve controls the interest rate on Treasury bills, subject to the condition that it cannot drive it below zero. The Federal Reserve is anxious to create a situation in which it can raise interest rates on the short end as far as possible without inverting the yield curve. But the long-term rate does what it wants, and at the moment the long-term rate is seeing a global shortage of safe assets, a global lack of opportunity to deploy savings in building bricks and mortar and machines in such a way as to yield a return. High-tech companies that do have opportunities for profitable investment, but they do not really require the activities they are undertaking, do not require money anywhere near on the magnitude of the savings flows being generated by even the global north, let alone the additional savings coming into global north asset markets from the south, from the global south, from emerging markets. That it is the long rate that will determine when the Federal Reserve stops its tightening cycle. And as one of Robert Schiller's original points, for which he won his Nobel Prize, backed up by Richard Thaler, whose Nobel Prize was announced this morning, and as Mr. Donovan said, who I think is an excellent choice, is that it is really difficult to say what a rational expectation of the long-term bond rate should be. And whenever there is not any large community with a very strong fundamental-based expectation of what an asset price should be, it will inherently be driven by behavioral economics concerns of one sort or another, of which, according to Dick Thaler, right now the most important behavioral economics concern is that since 1982, being long U.S. Treasury bonds has been a route to better numbers for your portfolio on average. That has got to have created bond traders, investors, and organizations with a bias toward long-term interest rates that are in some sense low, and that's been reinforced by the real side factors making for what we now call secular stagnation. Back when it was first identified, back in the early 2000s, Ben Bernanke saw it as a temporary global savings glut that was being generated by the desire of emerging market economies to hold larger reserves in case something like 1998 would come along again. And he said it would take 3 to 4 years for it to work itself out tops. That global savings glut would have come to an end in 2007, 2008. Something came to an end in 2007, 2008. It wasn't the global savings glut. It wasn't the exceptionally low interest rate on long-term government debt of exorbitant privilege reserve currency issuing sovereigns. Back in 2009, Ken Rogoff said that the big problem the world faced in the aftermath of 2008 and 2009 was that even before the crisis, we had seen a super cycle of excessive debt, which had been reinforced by all the losses of the crisis itself, and that it would take a while before this debt supercycle would unwind itself, but it eventually would, and then the configuration of asset prices would come back to normal. And I think back then, he and Carmen Reinhart gave it on the order of 5 to 15 years, which would have put us from 2014 to 2024. We're into that by 3 years already, and Ken has changed his position. 2 years ago, he said it would take an additional decade to unwind, and that we would not be seeing, that come 2025, nobody would be talking about secular stagnation anymore, thus pushing out his limit for when it will end to 2025 and collapsing the range into a date. He might well be right. He's an extremely smart financial economist. He's a brilliant analyst. But still, on this one, and possibly it's simply because I know Larry Summers better, And ever since I was 23, I found it impossible to maintain my own position when he attacks it, even if I'm right. I look at the configuration of asset prices, and I do not see anything that would tend to move us out of the current secular stagnation environment, which means that the Federal Reserve's tightening cycle has 2 more years to run, after which it will pause and we will wait for whatever happens next. Now, all of this is predicated on the Federal Reserve operating as it has worked, and on the community of economists whose views it listens to and responds to continuing to work as it has worked under this Fed. But might we get a very different Fed? Certainly we seem to have a very different U.S. federal government than I would ever have thought possible even a year ago. That, yes, back in late 1970s, my Republican friends thought it was worrisome that Ronald Reagan was the front runner for the Republican presidential nomination, because while he was a very convincing guy, and he was a very well-intentioned guy, he really did not have the policy chops to challenge cabinet members and others, and that he would tend to decide on issues the way they were framed when they were brought into his office, should he become president, and that we were electing not a President Reagan, but instead electing those of his advisors who could read him most, say, convincingly and bring issues to him in the framework in which he most would resonate with them, and we didn't know who those were going to be. But we elected Ronald Reagan, and then for 5 years, the extremely smart James Baker was prime minister. And admittedly, people in Europe were scratching their heads and saying, wait a minute, your prime minister isn't appointed by and confirmed by and responsible to Parliament. Your prime minister cannot be removed by a vote of no confidence in the lower house of the legislature. Instead, he just continues to serve as long as he has the confidence of the head of state. This seems to us like a return to an 18th century system that we got rid of in the 18th century because it didn't work. But, the U.S. government worked fine. You can argue the U.S. government did not work so fine in 1985-86 when Don Regan replaced James Baker, and James Baker moved over to the State Department. But then in 1987 and 1988, with Howard Baker as White House Chief of Staff, imposed upon Reagan by the Republican Senatorial Caucus, things worked fine again. And then come 2000, once again, there was substantial worry when George W. Bush, who did not really seem to have had the kind of interests in national policy beforehand that one would expect from a president, and did not even seem to have had the interest in issues affecting the government of Texas that, say, a Bill Clinton had had in policy issues affecting the government of Arkansas, became the front runner for the Republican nomination. But once again, the view was that the Republican policy bench was extremely strong and extremely competent, and things went less well. And people are still scratching their heads about how things went less well, and why it was the Donald Rumsfelds and the Richard Cheneys, who had been extremely confident and extremely capable as, say, chiefs of staff for Gerald Ford in the 1970s, turned out to be people whose judgment was substantially awry in the 2000s. But the U.S. government held together. Now we have nobody saying the U.S. government is holding together. We have senior Republican senators saying yesterday that it is too bad that the White House has become an adult daycare center, and somebody must have missed their shift this morning. We're not back in the 18th century anymore, with an enlightened despot as monarch choosing a prime minister and letting them then balance policy. We're back into something that looks much more like the 16th century, in which the person who manages to hand the head of state his shirt in the morning manages to determine policy that day, and in which the bureaucracy is at various levels engaged in various forms of passive and active resistance to try to undermine the daily decisions of the head of state in the hopes that the head of state can be brought around to be reasonable the following morning when someone else will hand the head of state his shirt. And this is a very fine way to run a government if it's on a television show, right? If it's, say, a record of the Tudor dynasty or the Ottoman Empire under Suleiman the Magnificent or Henry VIII, and we're watching it for amusement. It's not really what we want to see. As one senior Chinese policymaker told me last year, even before Trump was elected, totally without irony, what are you in the United States going to do to fix your broken political system? And I never thought anyone from China would ever be able to say that to me without irony. And I had never thought if someone did, I would not have an answer. But I do not. All right, that rant over. Nevertheless, this does not seem likely to apply to the Federal Reserve. We are very unlikely to get a very different Fed because Trump is simply not interested in the Fed. He has his real estate mogul kind of instincts, which are that low interest rates are good because if you do real estate, you borrow, leverage, and build. And you don't like people who raise interest rates because they make your life difficult. He also has your Republican instincts that sound money is good and interest rates that are too low create inflation in some time frame. These two fight each other to a standstill, and so he has no view. Thus, as a result, we have a profoundly non-unitary executive in which the permanent government will appoint Republican monetary policy worthies, most of whom think like the Fed already, and those who don't think like the Fed. The Fed is very good at assimilating new governors and bank presidents and even chairmen to its point of view. That at the moment, there still seem to be 6 people on the list of those who might be appointed Fed chairman, running from Yellen all the way down to Cohn. There are some worries about Warsh and Taylor because they have been perhaps a little bit too strident in their attacks on Ben Bernanke's monetary policy from 2006 to 2012. But I don't know anybody who truly believes that those views, as expressed then, would govern their policies were they become chair. That they would not regard themselves as being able to ride roughshod over the concerns of the bank presidents and the other governors. And so they would not be leaders, but instead followers of the Reserve consensus. In a way, much like Janet Yellen has been. That the kind of left wing of the Federal Reserve, Janet Yellen, who was president of the San Francisco Fed, has become very centrist Janet Yellen, speaker of the Fed consensus since. And aside from that, Yellen, Powell, Kashkari would all be excellent candidates. Gary Cohn does not know the issues, and if he becomes Fed chairman, it will only because he wants a parachute out of the White House. But since he does not know the issues, and since he is not a stupid man, and since he is surrounded by those who do, we are, I think, very unlikely to get a different Fed. That things are likely to continue very much as they are, no matter who is chosen. So, what will happen for the world? Well, I'm out of time, so you can read the slide if you want to. But as I said before, the Federal Reserve is going to lead central banks into new policy space, if there is going to be a movement into new policy space, and it's highly unlikely there will be. Instead, we're simply going to see central bank business as usual with a slow tightening cycle in the United States. And let me stop there, since I've already eaten 5 minutes into the question time.
Thank you very much, Bradford Dillon. Please take a seat. We have a couple of minutes for some questions. Thank you very much.
Well, not an easy picture that you were depicting, but
Well, but nothing terribly bad is going to happen.
that's
Yes.
what the way I would have liked
Yes.
to sum it up, actually.
Yes.
So pretty smooth years ahead of us, but maybe then just postponing an even bigger crisis in, let's say, 10 years or so.
That the view that we are rolling forward risks into the future, right, and hiding them off of people's balance sheets or in unnoticed places of people's balance sheets over and over again, and eventually they will come to pass. That is the nice thing about long-term interest rates at their currently extraordinarily low levels, is that from the perspective of the Japanese government, of the German government, even more so of the Swiss government, of the British government, of the US government, is that with interest rates at their current levels at least, the debt is not a liability that drains kind of resources, but is instead a profit center. That on an inflation-adjusted basis and on a GDP as numeraire basis, that these sovereigns are now all in the position of the Renaissance-era Medici Bank. That people elsewhere pay them to hold on to their money because it will be extremely useful if something bad happens and they need it. And whether it's the government of China wanting to have a large reserve position, both in order to prevent something like 1998 from ever happening to it, and also as part of reinforcing its program of we build up a community of engineering practice via large exports, or whether it's rich people all over the globe who would much rather have money in, say, Zurich or New York or Los Angeles or London than, say, in Kuala Lumpur or Moscow. Back in the Renaissance, the danger was that the Pope would declare you excommunicate, and you would have to flee the country and go to some place that didn't acknowledge the Pope and draw on the Medici Bank there. And so for the Medici Bank to have more liabilities was not something it feared. That's the situation that the major global north central banks are in. And so for them, a decade is going to see their liabilities be significantly less worrisome than they are today, which means that calm improves things as opposed to, say, the 1970s, when calm destroyed things. Now, this doesn't apply in Asia, where Japan and China have very interesting situations. But as far as Europe and the United States are concerned, a decade of growth and extremely low interest rates are likely to produce a sounder financial system than we have now.
Thank you very much. Let's see what kind and what questions we are getting from the audience. A couple of them, please.
I think that everybody, including the Fed, is always surprised by the weak.
Sorry. Can you start all over again?
It seems that inflation is always weaker than previously expected, even by the central banks. How do you explain that?
Well, this is a day when it's good that Richard Thaler has won the Nobel Prize. Right? That this seems to be a behavioral economics and a community of researchers and a community of analysts kind of perspective. That it is very hard to change your mind. It is very hard to mark your beliefs to market in any significant way. right, that you're very likely to spend a long time finding reasons not to move your view of how the world is as far and as fast as you do as new information comes in. And it's much easier to say that, well, this must be some temporary factor, but I am still right. And so as a result, we do indeed now have a period of 10 years since 2007, when the center of opinion on the Federal Reserve, on the participants on the Federal Reserve Open Market Committee, has been that inflation will be higher in a year than it has turned out to be, and that real growth will be faster in a year than it has turned out to be. And, we can apply criteria of rational expectations to this. What are the chances, if expectations are rational, that a coin flipped 10 times comes up head 10 times in a row? They're 1 in 1,024. And yes, the Federal Reserve and all its participants say that they have indeed incorporated this fact into their thinking, and that this time their forecast is accurate. But they've said this for the past 5 years, and it's nearly impossible to do. And as best as I can tell, they still are not doing it. You have to have someone who is very brave and very aggressive, willing to do a bottom-up rethink to do things differently. Like Martin Feldstein, for example. My teacher, Martin Feldstein, when he went to work in Washington in the fall of 1982, and took over Reagan administration economic forecasting. He said that every single quarterly forecast the administration has put out since its very first one has been grossly over-optimistic. We're going to do things from the ground up without even looking at what previous forecasts would be. And of course, his forecasts of growth massively understated how fast it was going to be, massively overestimated how big the deficit problem was. And he did indeed gain credibility for marking his beliefs to market, but he also lost it because he was then too alarmist about the budget deficit.
Let's give the audience a chance to ask one or two more questions. Over there.
So the topic this morning is regulation, and you talked about the current head of state in the United States approaching matters like a real estate mogul. If I recall, President Obama wrote Dodd-Frank into policy perhaps in 2010. Do you anticipate the current head of state to repeal or dismantle Dodd-Frank? And if you do you see that as an opportunity or a threat?
If you had a year ago asked me, I would have said yes, that Dodd-Frank would be repealed in all or in kind of substantially. And that while that might be a threat, that is, regulation exists more in the hearts and minds of the regulators than it does in the actual laws that they are applying. That as Hyman Minsky again said, that the problem with relying on regulation to control financial markets is the same kind of double mindset. Making it fear. So that you, Dodd-Frank, written largely by Dodd-Frank and by Michael Barr, now dean of the policy school at Michigan, was an attempt to use legal mind to repair problems that had already been repaired by the enormous shock delivered to the regulatory community 2007, 2009. So a year ago, I would have said that I would expect this year that it would not deploy their capital in ways that would be likely to produce somewhat higher rates of return, and that central banks had better stand ready to kind of be, once again, lenders of last resort, should it happen that the Minsky moment would come again. Now, we've had, January 4th was when the Republican Congress could have started moving bills, and we have nothing, and we do not even have an expectation of tax cuts for the rich, because there's not yet a plan for tax cuts for the rich. And, President Trump appears to be eager to alienate that the view was, say, that Obama had substantial congressional majorities, Trump had substantial congressional majorities. That's not the case. Senators Collins, Murkowski, McCain, and Corker have a congressional majority at their disposal. And kind of tweets that annoy them are not ways to get legislation passed. Right now, I would say that I do not know what's going to happen with Dodd-Frank next year.
Maybe that's the real thing we can say. We know less than before about the coming month, particularly in U.S. policy. Let's make a point here. We're a little over time, so I would like to answer my last question in a short way. I think it was Paul Donovan who said that Donald Trump is in the G5. He's the second most popular leader. What is the mood in Berkeley about that?
You say the mood in Berkeley is not, the mood in Berkeley is more uncomplimentary than one could possibly imagine. But then it's Berkeley. It's not supposed to be. The more interesting thing is the mood in the Republican congressional delegation. That is that a year ago, the Republican congressional delegation were pretty much all thinking we'd much rather deal with President Hillary Clinton than President Donald Trump. But if we go into open opposition to Donald Trump, we'll lose a bunch of legislature seats. And since we don't really have to worry about Donald Trump being president because he's going to lose, we can go all in support of him because the Democratic Party has this thing in hand. Turned out not to. Ever since then, they've been caucusing in various ways, wondering how to do it. And they're essentially still in the position of a 16th century legislature or House of Burgesses or House of Deputies or État Généraux, trying to figure out how do we control a king who is not fully rational. It was a very difficult problem. It was a very difficult problem for them back then, but they're at least taking more action. That nobody back, say, when the Tudor dynasty ruled England would dare say that someone overslept their shift in the adult daycare center that is Whitehall Palace. Nobody would have dared say that. And yet that's where we are.
Well, I think it was also Paul Donovan who said, luckily, it's not only politics who shape our economy, and I think we can hold on that. Thank you very much, Brad. Look forward to seeing you.